Welcome back to Switzer on Australia's business channel. Paul Rickard is a former banking executive and he's our banking expert on Switzer. But let's find out why our banks are copping a shellacking on the stock market, and we'll also ask what superannuations why did I write this word? Superannuants on part pensions should be thinking about doing after tomorrow night's budget. Pretty important question for a lot of my viewers. Paul, thanks for coming on the show.
How you going, Peter?
Superannuants. I don't know why I wrote that.
That's a tough word.
Okay, this is a tough word. All right. A lot of our viewers are in the banks. I like banks, but I've talked to you over the last 3 or 4 months, and we've kind of said probably time to lighten off if you're very long banks.
We did talk a bit about going close to index weight. Let's look at what's happened and why. Let's start with the why first.
Okay.
So we've had sort of 3 reasons drive bank prices a bit lower. First of all, as Michael was talking about earlier about bond rates.
Yeah.
And that's to do partly with the yield trade. That is, the question whether interest rates may have bottomed, and so the bond market's getting a little bit anxious globally, and so, banks need to get a little more attractive. That means the price needs to drop a little bit to make them a bit more attractive compared to bonds.
Yeah, so with the pros, people like us, we're not going to go chasing the bonds,
no.
But it's the pros who might.
It's some of the professional investors and some of the funds just saying that these bank prices are probably a bit steep. So that's the first reason. Secondly, Peter, we saw some pretty downbeat earnings reports last week from each of the banks reported. Commonwealth Bank probably only through a quarterly report, but by and large there are a couple of takes out of that. Revenue growth pretty low, and by and large earnings growth has stalled. So there's really very little extra sort of income coming through from the banks.
Is this part of the fact that the economy is kind of slow? The faster the economy goes, the more likely their earnings will improve?
Yeah, I think it's a couple of reasons, Peter. I think credit growth, as we know, has been pretty slow, particularly in the business side. It's picked up a little bit.
It's great on residential housing, but hopeless on business. Yeah,
but still it's only sort of 8 or 9%. And, of course, NIM's been under, net interest earnings have been under pressure. So, really, there hasn't been a lot of revenue growth. And secondly, a lot of the bottom line sort of impact on banks' profitability has come out of bad debts falling, and that's sort of now stopped. Yeah. And secondly, they've done a lot of cost cutting, and so some of those easy cost cuts are out of the way.
Yeah, that's true.
And so they're sort of now growing at 4 or 5% rather than sort of the high single digits. So growth is sort of almost stalled.
So it's bonds, it's earnings, and also it's capital.
So they're all talking about more capital. We've known that for some time. We saw a capital raise from the NAB. We saw a couple of other things come out last week. I've got a little chart here which just shows you how great banks have been as performers, and also just what's happened the last month.
And they have. They've been extraordinary performers. So what's the bank?
So in the green line, we've got this is looking over a 5-year period. This is the total return of investment in the financials index, excluding property trusts, versus the ASX 200. You can see banks in the green line, the ASX 200 in the blue line. Banks are way ahead over the 5-year period, but in the last month or so, month and a half since the start of April, the market's off 4.4%, banks are down 9.2%. So certainly there has been, you'd almost say, a correction in bank share prices. Okay,
so the next question for people watching is, is it time for me to dump my bank stocks? And another question is, if I'm not in banks at all, I've never been in banks, is it time to actually buy them at these low prices?
Yeah, so I think the answer to that question is, look, banks are such a big part of our market. Yeah. So that the financials index is about 40% of our market. So, and the major banks make up 3/4 of that. So, for example, if 30% of your portfolio, 30 to 40% of your portfolio is invested in banks, you're about index weight. Yep. You've got 60%, and a lot of private investors who have 60% in banks, and there are others who might only have 10 or 15%, and they're below index. Yeah. So, look, I'm a believer that you don't take that much risk in terms of your sector allocation. I don't think you dump your banks, but if you're overweight, I think this is the time to start to pare back a little bit. Yeah. And so you can do that a couple of ways. You can be aggressively out there selling. I'm not sure that's the smart trade. No. There are other ways to start to pare back your exposure, is just through don't take part in dividend reinvestment plans. Don't take part in capital raisings, because the NAB's doing one in a couple of weeks. Next week, retail investors have a chance to say yes or no. And you can do it on a more passive basis. Yeah. If you're very underweight, there's probably some good opportunities around there. Yeah. I don't think the yield trade is dead. I don't agree with the bond market, and I think but you've got to be careful. More capital means, effectively diluted earnings.
More shares out in the market.
Lower earnings per share.
Paul, I guess there's another important point, that if you're someone who bought CBA at 45, it's okay you're long. Your yield's probably around the 8 or 9%. plus franking credits. So it's the people who probably bought at very high prices, they're the ones who might think about their actual weighting.
Yeah, particularly if you can afford to take some of those capital gains and pay the tax.
Yeah.
Even at current prices, banks are yielding between, on a pre-tax basis, between 5.1% and 5.7%.
Yeah.
You gross that up for franking credits, particularly if you're tax advantaged in the super fund, and you're talking about 6s and 7% numbers. They're still pretty attractive yields compared to cash at 2%.
Yeah.
And, I don't think bank earnings are going to collapse, but I think what we're seeing is that there may have the growth has come to an end.
Yeah.
And so maybe the best clue is still going to be the bond market. If bond rates go higher, I think banks will be under pressure. If bond rates stabilise, then I think maybe bank shares prices will...
All good things come to an end, Paul, I guess. But I still think banks, if the market goes up 10% next year, I think the banks will probably go up 3 or 4%. Plus you get dividends.
Yeah, and I think you've got to look at that. That's one of the reasons to lighten, because in a really strong bull market, they'll probably lag a little bit.
Yeah, OK. Let's just, because the budget's coming out and the big breaking...
Anything to look forward to tomorrow.
That's right. And the big
We're all very excited. One more sleep to go.
That's right. The big breaking news, I guess for a lot of my viewers, is if they are superannuants and they've got $823,000 in assets, including their super, outside of their home, they're going to lose their part pension. That's the expectation.
That's the expectation. So there's a little chart that we've got which just shows that. So there are a couple of changes which were announced last week applying to part pension.
Yeah,
hopefully that'll come up. So this is looking at a homeowner. So the two changes are, first of all, Peter, the taper rate, that's the rate at which your pension reduces, was increased from $1.50 per fortnight of your pension for every $1,000 of assets to $3 per fortnight, doubled.
It was under John Howard.
Yeah, and it was gone back to $3, and also the minimum amount of which is exempt from the taper has increased. So the net effect of that for a couple, for example, have $250,000 worth of, for a couple, $375,000 of assets and get the full pension.
Yeah.
As soon as you get up to $823,000, you get the part pension, and above $823,000, no pension.
No pension.
So that's enough.
We don't know about the healthcare implication yet, do we?
We do. Yes, we do, because what they've said is, first of all, these changes don't come into effect till the 1st of January 2017.
Yep.
And secondly, they said they'll grandfather anyone who's currently getting a part pension and has access to the pension and health card will be grandfathered access to the seniors health card.
But they'll lose the part pension.
They'll lose the part pension.
OK.
So that affects about 326,000 Australians. And at that top amount, someone with about $823,000, they stand to lose about $14,500 a year.
Yeah, and I've seen a very interesting comparison where someone who's on, I think, $400,000 in super and other assets compared to the person on 823, if that person would also be able to put that 400, get about 37,000.
Yeah, look, just a bit over 34,000.
The part pension, 37.
Yep.
They can invest their 400 at say a safe 3%. There's 12 grand. They're going to be around 40,000. Might lose a little bit on the income test, but let's call them at 40,000. If the person on the 823,000 invests their money at 3%, well, that's only 24 grand. So they have to increase the risk up to 5%. A 5% return, they would then get 40,000. It's a big encouragement for people at 823 to somehow whittle that 823 down.
In very low interest rates, we've got cash rates at 2%, term deposit rates out to 3%. It's really forcing part pensioners, superannuants, to take a little more risk. Yeah. Which is one of the reasons why you can't get too cold on the share market, because you realise that people are going to have to take a little bit more risk. Yeah. But it's certainly, I think, one of the unexpected changes of what we're seeing. I think there's good reasons perhaps to apply with this rate, but certainly one of the strategies people are going to think about is well before retirement whether they should do a bit more serious income splitting or gifting. Yeah. You can't give all your money away because the Department of Human Resources are pretty smart, and they look at gifts over the last 5 years.
Yeah.
But, for people that are, 5 years away from pension age, which has now gone up to 67, a strategy out there might be to gift some of this money to, if not your spouse, at least your adult children, and ask them to look after you in retirement.
And also reallocate between husband and wife could be a smart strategy as well.
And there's going to be some of that, particularly if you've got a younger spouse, to reallocate that beforehand. So it's going to make life for a lot of people on that sort of battler level, with some superannuation and still some dependence on the pension, pretty tough.
It probably creates some business for advisors as well.
Probably creates some business for advisors. So that's one of the changes for tomorrow night.
OK, mate. Thanks very much, Paul. So coming up, we'll see if India is safe for investing.